It's a great day at Equity. Today, we are going to discuss the topic of mortgage fraud. What is it, and what can be done to prevent it? Mortgage fraud, as defined by the Federal Bureau of Investigation, the FBI, is any sort of material misstatement, misrepresentation, or omission relating to the property or potential mortgage, which is then relied on by the underwriter or lender to fund, purchase, or insure a loan. There are two distinct areas of mortgage fraud: fraud for profit and fraud for housing. Fraud for profit is when industry professionals use their specialized knowledge or authority to commit or facilitate fraud. This type of fraud is not aimed at securing housing, but rather to misuse the mortgage lending process to steal cash and equity from lenders or homeowners. It is important to note that the fraud for profit can be committed by any professional in the loan transaction, including the builder, real estate sales agent, loan officer, mortgage broker, debt counselor, appraiser, property inspector, insurance agent, title company, attorney, and escrow agent. Fraud for housing is when a borrower falsifies information or takes illegal action to acquire or maintain ownership of a house. The borrower may, for example, provide false income and asset information on a loan application or entice an appraiser to manipulate a property's appraised value. Some of the common areas of this type of fraud are the following. Application fraud is when a borrower intentionally supplies false information about employment history, income, or identity in support of a mortgage application. Credit liabilities fraud may include a borrower's misrepresentation of credit score and/or amount of debt to qualify for a loan for favorable loan terms. Employment fraud occurs when a borrower or straw buyer misrepresents his or her employment to the lender. The fraud may be committed to make the borrower appear more financially qualified for the loan or to conceal the illegal source of future loan payments. Fraudulent identity theft, or what some call synthetic identity, occurs when incorrect identification credentials are used by an individual otherwise ineligible for a mortgage loan or as a part of a fraud-for-profit scheme. Fraudsters may also create synthetic identities using bits and pieces of valid information from disparate sources. Income down payment fraud involves providing false income information to qualify for a loan. A borrower's income and assets may be inflated or completely manufactured. Down payment fraud involves disguising a loan of down payment funds as a gift. Becoming familiar with the different types of fraud for profit or fraud for housing can assist each person in the transaction to identify common mortgage fraud schemes and red flags. Some possible red flags include the following: significant sales price adjustments that are not supported by comparable market data, required use of particular appraiser, large seller contributions, a buyer's intention of occupancy is questionable, such as a buyer retaining old property, or there is an unrealistic commute to their employment. Buyer has very limited credit history, unrealistic income for occupation, recent drastic increase in income due to a raise or a new job. Sales contract, appraisal, and title work disagree with respect to the seller's name, and appraisal shows property previously sold in past year. If any of these red flags are presented in your transaction, bring it to the attention of your lender. While fraud isn't involved every time one of these red flags appear, the few minutes it takes to determine what is legitimate and fraudulent can save you and your lender time, money, and maybe even your license. And reporting fraud will protect the communities in which you do business. Thank you for joining us. Don't forget to like this video, subscribe to our channel, and turn on post notifications to never miss a new video. Please leave a comment below if this video was helpful and if you'd like to see more videos on similar topics.